Have you ever wondered how your interest rate is actually set on your conventional loan? Today, I'm going to break down how interest rates work on a conventional loan, what affects them, and how you can get the best interest rate possible on your next home purchase. First, if you don't know, let's start at the very beginning, the absolute basic with the mortgage interest rate and what it is. The mortgage interest rate is the cost that you pay the lender who gave you the money for financing your house. With a conventional loan, there are two options as far as interest rates go. There's a fixed rate and an adjustable rate mortgage, or an ARM as it's often referred to. As it sounds in the name, a fixed rate is just that. It's fixed for the life of the loan, no matter your term, whether it's 15, 20, 25, or 30 years, that interest rate is never going to adjust. An adjustable rate mortgage is just that. It can adjust. It does lock for a certain time period, but not for the entire life of the loan. And then there's adjustment periods where it can change either once a year or every 6 months. So again, the fixed rate is fixed for the life of the loan. That's the easy one. The adjustable rate, we typically see these at a term of 3, 5, or 7 years, and they adjust after that time period. So let's say you select what's called a 3-1 ARM. That means the first number, 3, would be the lock period. The interest rate you select is locked for 3 years. For all intents and purposes, during those 3 years, you have essentially a 3-year fixed interest rate. But now, the second number in our 3-1 ARM is the 1. That would mean that your interest rate after those 3 years and the fixed period is opened up can adjust once per year. Typically, when an adjustable rate mortgage will adjust, it's based on an index called the Secured Overnight Financing Rate, or SOFR. Here's some factors that can affect your interest rate, and it all starts with your credit score. As with anything credit related, the higher the better. It's just how it works, and it's probably how it always will. The minimum credit score on a conventional loan is a 620. If you have a 760, you're going to be getting the best of the best that the market has to offer when it comes to your interest rate. If you have a 620 credit score, it's going to be a little rough. The markets do adjust for lower credit, and there's a certain level of risk that comes with someone with a 620 credit score versus someone with a 760. The next piece that can affect your interest rate is your loan to value, which basically is how much money are you putting down when you are purchasing your new home. If you put down anything less than 20%, you're going to have private mortgage insurance, and there is going to be an adjustment to your interest rate. Typically, it's a little bit higher than somebody putting down 20%. Here's one that can affect your interest rate in a positive factor, and that's if you take a shorter loan term. Typically, we see these rates are better. If you compare a 15-year mortgage interest rate and a 30-year mortgage interest rate, the 15-year will always carry a lesser rate. However, you're cutting your term in half, so the payment is always higher to pay back the amount of money over a shorter period of time. To make up for the increased payment, there's a lesser interest rate. The last thing that can affect the interest rate is something you probably already know, because whenever the Fed makes a big decision, it's all over the news. But the economy, inflation, and the Fed all have outside determining factors that can affect your interest rate. Once you secure a mortgage and you have a fixed rate, you don't have to worry about that anymore until you go to buy your next home. But if you take an adjustable rate mortgage and you're in your adjustment period and outside of your beginning lock period, you need to be very aware of what the market's doing, because if interest rates go up and you're on an adjustable rate, your rate is not going to be going down. I can tell you that with 100% certainty. Now, one cool thing with a conventional loan that some people offer is called premium pricing or lender pricing, and this is something not a lot of people know is an option when they're buying a home. Now, with interest rates, there's always the opportunity to buy it down. Let's just say I come to you and say, hey, Mr. Borrower, the interest rate today is X. And you say, oh man, I really wanted to be down here at Z. Okay, let's take a look at it. I run my numbers, I look at all the details, and then I come back to you and say, okay, if you want to get down to Z, it's going to cost $3,000. You can buy your interest rate down less than what is being offered. It's called a permanent interest rate reduction buy down. So a completely hypothetical scenario is, let's say you wanted your interest rate to be 5.5%, and my interest rate today and what the market calls for is 7%. You could buy down to 5.5%. You're not going to like the number I tell you, but let's say I come to you and say, hey, you can get 5.5%, but it's going to cost $35,000 to do it. Do you think that's worth it? You say yes, agree to pay the extra fee, and you can buy your interest rate down. The other side to that is you can go the other way too. And maybe you need help with closing costs. You have enough for your down payment, but you don't have enough money to pay the closing costs. This is where lender credits and premium pricing comes in, which means you can go up above what's being offered today to get a rebate. So if I say that interest rate X is the going rate today, and you say, well, what about R? We'll go the other way on the alphabet scale. I say, yeah, you can do that. And if you took that, that would give you a $4,800 credit, which will go to offset some of your closing costs so you're not paying those out of pocket. Financially, long term, it doesn't make sense to do that because you're taking relief up front to pay your closing costs, but you're going to pay more every single month by doing that. And it's going to amount to a lot more over 30 years. But it is an option with almost every lender in the United States. To conclude this video, the higher your credit, the more money you're putting down, and the more financially secure and stable you've been over your life, the better interest rate you're going to get. A side note, shopping around with different lenders is another way that you can make sure you're getting the best deal. Not all lenders are created equal. Believe it or not, Bank A can be offering a different rate than Bank B, but I always recommend a mortgage broker like myself. And the reason for that is I'm partnered with 150 different lenders. So while you might go to Bank A, they're in their portfolio at Bank A. And then Bank B might be a little bit better than Bank A and they're in their portfolio. But I'm in portfolio 1 through 150, shopping all of them against each other for you on your behalf to get the best interest rate. So I always recommend a mortgage broker. However, I just recommend multiple opinions. You go where you're comfortable and get multiple quotes. This is the biggest transaction you'll ever make in your entire life, in most cases, unless you decide to buy a business. When you're buying real estate, you're financing hundreds of thousands of dollars in most cases, and saving an eighth of an interest rate point over the life of the loan is tens of thousands of dollars, so it is worth it to do some extra homework and shop around. If you found any of this info helpful, make sure you like the video, share it with anybody who you might also think will find it helpful, and subscribe to the channel. We'll see you on the next one.